Welcome to our deep dive on the high-risk, high-reward auto refinance strategy. In this video, we will explore how some buyers accept a high initial dealer interest rate to unlock rebates and then immediately refinance to a lower APR to secure long-term savings. We will walk through how to assess APR versus interest rate, how to avoid hidden fees, how to confirm there is no prepayment penalty, where to find the lowest rates, and the exact steps to execute the fast refinance pivot. To keep things smooth, we will use clear transitions between sections, and we will also include a couple of quick quizzes to check your understanding. Let us begin. Here is our agenda. First, we will define the refinance strategy and why it can make sense. Next, we will compare APR versus the simple interest rate. Then, we will uncover the hidden trap of fees. After that, we will give you a step-by-step, fast refinance checklist and a practical timeline. We will compare online lenders with local credit unions. We will run quick math examples for savings and break even. Finally, we will test your understanding with a couple of mini quizzes before wrapping up. This content is educational only and not financial advice. Individual circumstances vary, so you should do your own due diligence and consult a qualified professional before making decisions. Interest rates, fees, and lender policies change frequently. Any numerical examples shown are illustrative and may not reflect your specific situation. Proceed only after reviewing your contracts and confirming details with your lender. The core idea is that some buyers accept a higher dealer rate to unlock significant manufacturer rebates or incentives. Then, they rapidly refinance to a lower APR, typically within a few weeks. This approach attempts to capture the immediate savings from rebates, plus the long-term savings from a lower APR. The key is speed and diligence. You must immediately pivot to a new loan with stronger terms, otherwise the high interest cost erodes your benefit over time. When comparing loans, do not focus solely on the nominal interest rate. The annual percentage rate, or APR, incorporates mandatory fees and reflects the true cost of borrowing. Reduction from 7% to 5.19% across a 60-month term can create substantial savings. However, you should compare APRs side by side across lenders. If one lender advertises a lower rate but structures high fees elsewhere, the APR will reveal that the total cost is not actually better. Always prioritize APR comparisons. This flowchart illustrates the decision process. First, you ask whether you accepted a high dealer rate to capture rebates. If not, you may prefer to keep your current loan. If yes, the next checkpoint is whether the refinance APR is lower by at least about 1 percentage point. If not, you might stay put. If yes, you then demand a full itemized breakdown of all fees. Next, you determine whether those fees can be recouped by interest savings within 6 to 12 months. If not, the refinance may not be worthwhile. If yes, confirm that the prepayment penalty on the new loan is zero. Only then do you proceed to apply and refinance quickly. This pie chart illustrates that APR includes both the periodic interest cost and mandatory fees, such as origination, title, or document fees. Even if a lender presents a low nominal rate, higher fees will push the APR higher. That is why comparing APR across lenders is the fairest way to evaluate the true cost. It consolidates the costs into a single comparable metric. Refinancing is rarely free. Some aggressive online lenders offset a seemingly low rate with various fees, including origination, title transfer, or document preparation charges. If a quoted rate appears unusually low compared to competitors, you should scrutinize the closing costs. A practical rule is to avoid refinancing if the fees cannot be recovered through interest savings within 6 to 12 months. Always request a full itemized fee breakdown up front before you submit a formal application. This illustrative example assumes a $35,000 loan over 60 months. At 7%, the estimated monthly payment is approximately $695. At 5.19%, the payment is approximately $664. That is about $31 less per month. Estimated total interest falls from roughly $6,690 to about $4,865, saving approximately $1,825 over the full term. Your actual numbers will vary based on exact timing, fees, taxes, insurance, and payoff details. Use these figures as directional guidance only. To execute the fast refinance pivot, first capture any dealer rebates, then move quickly. Pull your credit reports and consider freezing them to avoid unwanted inquiries. Gather identification, proof of income, insurance, and request a payoff letter from the original lender. Pre-qualify with 2 to 3 lenders to compare APRs, preferably using soft inquiries. Prioritize local credit unions and obtain their full fee sheets. Calculate fee break-even by dividing total fees by the expected monthly savings. Confirm in writing that the new loan has no prepayment penalty. Enable autopay and ensure the original loan is paid off correctly. Verify the title transfer process and any state-related fees in advance. After funding, keep monitoring both the old and new accounts until the original balance reaches zero and the title updates are complete. This 4-week timeline shows a practical cadence. In week 1, you gather documents and request a payoff letter while pursuing soft pre-qualification. In week 2, you compare rates across credit unions and online lenders and audit fee sheets carefully. In week 3, you select the best offer based on APR and break-even analysis and then lock terms. In week 4, you sign the new loan, fund the payoff to the original lender, and verify that title updates and autopay are correctly set up. This comparison contrasts national online platforms with local credit unions. Online platforms typically offer fast applications, instant offers, and broad rate discovery, but some may include aggressive or less transparent fee structures and variable service quality. Credit unions, by contrast, often provide some of the lowest APRs because of their nonprofit status. They tend to be more transparent with fees and offer local support, though membership requirements and occasional in-branch steps can add friction. For best results, use online platforms to understand the market, then negotiate or apply through a reputable credit union for potentially better overall terms. Here are quick calculations you can perform. First, calculate months to break even by dividing total fees by the expected monthly savings. For example, if fees are $300 and you save approximately $31 per month, the break-even point is about 9.7 months. Second, note that the monthly payment change scales roughly with loan size. If a $30,000 loan saves about $26 per month when dropping from 7% to 5.19%, then a $35,000 loan saves approximately $31 per month using a proportional estimate. Third, always verify in writing that there is no prepayment penalty. If a penalty exists, it can undermine the entire strategy. Quiz time. Which metric should you prioritize when comparing refinance offers? Option A, the nominal interest rate only. Option B, the APR, because it includes mandatory fees. Option C, the monthly payment only. Option D, the lender's brand reputation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The APR includes both the interest rate and the mandatory fees, so it captures the true cost of borrowing and enables a fair comparison across lenders. Second quiz. If your refinance fees are $360 and your monthly savings are $40, is the switch worthwhile under a 6 to 12 month break-even rule? Option A, yes. The break-even is 9 months and within the window. Option B, no. The break-even is 18 months and outside the window. Option C, maybe, but only if the original rate is fixed. Option D, only if the dealer approves it. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Dividing $360 in fees by $40 per month in savings yields a 9-month break-even. That falls within the 6 to 12-month guideline, so the switch is generally worthwhile, assuming other terms like prepayment penalty and title fees are acceptable. These are the key takeaways. Move quickly after capturing rebates. Compare APRs rather than just nominal rates. Demand a full fee breakdown and run a 6 to 12-month break-even analysis. Confirm that the new loan has a 0 prepayment penalty before you proceed. Finally, give credit unions serious consideration, as they often provide the best overall deal. To wrap up, accepting a higher dealer rate can make sense only if you refinance quickly. The APR is the most important metric because it incorporates fees that can negate advertised rate advantages. Use a 6 to 12-month break-even yardstick to decide whether the refinance is worthwhile. Confirm that the new loan has a 0 prepayment penalty and verify the title transfer process. Shop broadly across the market, but strongly consider reputable credit unions for the final loan. Thank you for watching. If you found this valuable, please like the video, share it with someone who could benefit, and subscribe for more practical money tactics. Post your questions and your real-world refinancing results in the comments so we can learn together. See you in the next one.